their insurance, their taxes, their food, their gas, their car payments. Everything's gone up. Guess what they've done? Now max out those credit cards, but all of a sudden, there's no more equity line to pull. So we're starting to see that hit the market. And again, I may sound gloom and doom. This isn't a 2008 thing.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larson. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's show, we have Chris Seveney. Chris is the CEO and co-founder of Seveney Investments, and he brings over 25 years of real estate know-how. And he's going to talk about what he's learned during this period from doing fix and flips as a real estate engineer, developer, as well as what he's doing today. And his journey with Seveney started in 2016 when he jumped into acquiring and trading mortgage notes. Chris has since built a portfolio of over 500 notes, totaling over $25 million, spanning many different states. And before diving into mortgage notes, as I mentioned, he had a standout career managing a multi-million-dollar asset portfolio, overseeing property projects worth over $150 million. Throughout his 25-year career, Chris handled $750 million in new construction products. And at Seveney, Chris is a beacon of real estate excellence, known for his commitment to honesty and professionalism. His passion and determination make him a trusted leader, earning respect from partners and colleagues. Outside work, Chris is a father and an avid Boston sports fan, which adds a personal touch to his journey. Chris, welcome to the show.
Chris, thanks for having me. Excited to be here today and talk shop.
Absolutely. How many times can we say Chris? We could go back and forth. Chris.
Yeah, I know.
Yeah.
So really get everyone to tune us off very quickly.
That's right. Yeah, they'd be like, So, well, this will get them interested, Chris. So, you and I were talking before the show. We were talking shop, and I was like, we just got to hit record because this is what the podcast is supposed to be about. I'm definitely a financial nerd. We're going to dive into, kind of the macroeconomics about what's going on in real estate right now, how your firm is taking advantage of some of these trends and specifically in the note space. But before we get into that, I'd love for you to share with our audience a little bit about your background, and what your business really is all about.
Yeah. So I am a nerd as well. I'm a numbers nerd. Start with my business today is we run a non-performing note mortgage fund is what we do for accredited and not accredited investors. So it's a little bit different where most people just do the accredited, but we went through that Regulation A+ process. So
Yeah.
I feel like I have a degree in SEC qualifications for having to submit to the SEC. I got into this space, I'll say accident, and I thank or blame my wife. I've been in real estate since the age of myself, the late 90s. I went to college, got a civil engineering degree, spent 15 years working for a commercial general contractor, working 60 plus hours a week, the W-2, the grind. Then I moved over to what's called the dark side of the industry. I went from the construction side over to the development side. And everyone on the GC side, you to the dark side. And what was interesting is people on the development side are much more entrepreneurial. And my boss at the time joked, he's like, what are you doing for retirement? I'm like, my 401k. And he's like, oh, so you're a 40 guy. I'm like, what do you mean? He goes, you work 40 hours a week, or actually 60 for 40 years to get 40% of your income that you're never going to be able to retire. And I'm like, yep. So it flipped the switch because he owned a lot of rentals.
Okay.
And
that's a great, you know what? That's a great 40. That's something that I imagine if somebody said that to me, that would just stick in the back of my mind and would just eat away until it made me do something.
And it did.
Yeah.
And for me, he had rentals and I was looking in the rentals, but at the time I had gone through, I was, several years out of a divorce, gotten remarried. But for anyone who's ever gone through that process, it can be, damaging from a financial picture, going through that. And my wife and I, we bought a piece of property in the Washington, D.C. area to build a house. So we built a house. I acted as a GC, which really my wife acted as a GC more than probably I did. But we built a house, and it was in 2013, and we had a ton of equity when we finished it.
Yeah.
So we took our equity and we started doing, back at the time, the bigger pockets BRRRR strategy, which is line of credit, pay cash, renovate it, get all our money back out, pay off the line of credit. And then it was cash flowing or close to cash flowing. Because what we did at the time was my son at the time was about 3. We put on 15-year notes. And we did that because they'd be paid off right when my son goes to college. So, you know, and these, I think we still have them. Rates are 2.5, 2.75. So it makes 0 sense to pay them off. So we started doing that, but our young, and my wife was like, we can't do this anymore. I mean, our date night was renovating properties, which, you know, was cool for a guy, not so cool for the other side.
It's cool for you. Yeah. Which if it's not cool for your wife, it's not cool for you. Yeah.
Exactly. So she's like, we got to do something else, and highly competitive market. So I stumbled upon note investing, and I heard about private lending, but I didn't know there was this note world. And this was like 2016 timeframe.
Yeah.
So I was fascinated because I am a numbers nerd like you.
Yeah.
And you can do note investing anywhere on the planet as long as you have internet, and buy loans pretty much wherever you want. So I felt it was love at first sight.
Yeah. No, and look, I heard about it. We were chatting before the show. I invested in a note fund and actually bought some of my own about 10 years ago before I got into the multifamily space. And I was like, oh, this is so cool. You know, you can buy this. It's just financial engineering. And we were buying non-performing notes as well. Chris, you mind sharing? So first off, you know, I think some people, if they're listening, they're like, I'm going to invest in a non-performing note fund. Is the fund not performing? Is the note not performing? You know, it's one of those things. It sounds funny where it's like, oh yeah, like that's like I hear it now knowing what it is. It's a great opportunity. But the first time you hear it, you think, why on earth would I do that? Like what I like to equate it to kind of like a foreclosure in a home. You know, how would you describe a non-performing note, and how is it different than a performing note?
Yeah. So great question. That's what we get asked all the time is why would you buy something when someone's not paying you? And what we like to use the terminology is we fix and flip loans.
There we go. That's a great analogy.
So a lot of people fix and flip houses, which is you fix it. So you're buying it dilapidated. And when you're buying it dilapidated, you buy it at a discount. Then you put in the sweat equity of getting it fixed up to then turn around and do something, whether keep it or sell it. And we do the same with the loan where we don't own the house. So if their toilet breaks, they don't call us. You don't call, you know, Chase or Bank of America or whoever when the toilet breaks. So we'll buy that loan, and I'll use rough numbers. Let's say the borrower owes $100,000. We might buy it for $70,000, $60,000. So we're buying it at a discount, which gives us the ability to then go back to the borrower, say, let's work on some new type of payment plan. But we also have, you know, you can dangle, you know, the foreclosure if they come to play, or you can't work something out with them. And then if you foreclose, typically you want equity in the property. So you want the property to be worth like 150, because if they don't work out some payment plan, then you get whatever they're owed, it sells at auction. So that's the difference between non-performing is they're not paying. Now, I'll add one caveat to this, and sorry for doing all the talking.
No, this is great. This is why we have you on. People can listen to me talk. I can just do a solo cast at that point, you know.
Most people think that if you miss a mortgage payment, you know, you get 50 phone calls, somebody come beat down your door and drag you out kicking and screaming. That's not the case. Yeah, they may call you a lot, but they never take action, or rarely, because banks are typically not in the business or have the infrastructure to deal with this.
Yeah, they don't want to do it.
Yeah. So the average delinquency on loans we see is usually like usually about 3 years. Not months, not
2
days.
to 3 years. So it's
years.
Yeah.
Yes.
Yeah. Now that's, to be fair to the audience, if you're thinking, oh, I can save some money by not paying my mortgage, that's not good for your credit to do that.
No, I don't recommend that. And, you know, where we call, you know, this is the time where I saw this item come up this weekend about the whole Chase glitch. I don't know if you heard about that. Where
I think I saw it. Yes. I didn't read deep into it. I saw it come across the ticket.
Yeah, but people basically creating bank fraud to get out of an ATM. But I I don't recommend you try and take on banks. Just,
yeah.
I joke today, this morning, I said, banks and cartels are two types of businesses you don't want to mess with because they have lots of money and they have lots of power.
Yeah, absolutely. Absolutely. Yeah, so that's a great explanation of, why a non-performing note versus a performing note. And to your point, if you're buying it at a discount, Chris, then your returns can be significantly higher than if you have a performing note. And just to give an example, so we bought an office in downtown Asheville from the bank. It was a foreclosure. It was 50% occupied. And because we got the property at similar type discount, say 30-40% off, we were able to market it. I was able to get people to come in at lower lease levels than other offices of similar quality because my numbers worked. So I filled it up faster, and then I was able to kind of slowly raise rents over time. So if you're kind of thinking about it in a numbers perspective, it's very similar, but you don't have to do as much manual labor necessarily, like a fix and flip, and do it that way. So before we get into kind of what we're seeing in the market today, you mentioned something, Chris. You guys started a Reg A fund, and I know that some of our listeners are familiar with Reg D. So there's Reg D, there's 506B offerings, there's 506C offerings. So with 506C offerings, only accredited investors are allowed to come in. And you have to have a third party basically prove that you're accredited. That could be an accountant. You could go to a certification service that shares that. The nice thing is, so we have a 506C fund, and you can say, hey, Chris, you should talk to my neighbor or my friend or family member about that. And even though I don't know them, they can invest in it if they're accredited. The nice thing about our 506B offerings that we've done in the past is that if you introduce me to another family member that's not accredited, then they might not be able to invest in our current offering. But the next time we have one that comes up after we have that established relationship, once we've talked, seen what their goals are, maybe met in person, they can invest in that. And there's limits to that, so I won't go into all the specifics. So 506B for as a summary, you can allow some accredited investors, some non-accredited and accredited, 506C only accredited. And how is Reg A different than that, Chris? How does that work?
Yeah, so I joke as the math nerd, A equals B plus C, meaning
hey, I love or yeah, it's funny. I was just talking about my son's in geometry. A squared plus B squared equals C squared, right?
So, yeah. So you can take essentially the best parts of a 506C and a 506B and almost combine them. And what I mean by that is Regulation A came out during the Jobs Act, and I think this around 2017 is when the Regulation A offerings really started rolling. But it allows you to advertise, to raise from accredited and non-accredited.
Okay.
Non-accredited is, I think, 10% of their net worth. Everyone self-certifies themselves, so you don't need third parties.
Okay.
So that sounds like really, really good. Our minimum offering is $5,000 is a minimum investment. So everyone's like, wow, wow, wow. And then, here's the side of things.
Yeah.
One is it is a lot more scrutinized because of that non-accredited side.
Sure.
So your PPM gets submitted to the SEC, what's called an offering circular. So it has to be reviewed by the SEC, and the SEC will give you a qualification. They don't approve anything. They qualify it saying you're good to go. Okay. Then every year you have to submit audited financial statements and a semi-annual unaudited report. So it's kind of a quasi IPO where you have to do like 10K statements and everything, but there's significantly more reporting. So there's a lot more costs involved in getting it. Hey, I can go spend 10, 15 and have an attorney put together a PPM for 506C. Get a Reg A started is about, cost 75 to 100 grand. Give people an idea.
Yeah. Now, is that evergreen? Like, is your fund going to be evergreen for that much money, or do you have to close and open them frequently?
Every 3 years, you have to basically, so every year you have to get requalified, but after the third year, you have to stop it completely, but restart it again. So you have to go through almost like a brand new process. So as an example, we use broker dealers to raise money as well on the institutional side. So people familiar with that space, you have to get selling agreements with them. So every 3 years, we have to get new agreements with them essentially to, but other than that, we just change the class of whether it's a share or a bond. It's just, this is say next one's class B. So for the investors, they really don't see much of a difference.
Yeah. Gotcha. That's interesting. I think that's going to be new information to a lot of investors that, may be familiar with some of the offerings out there. And, the thing that I love is that this just gives more investors the opportunity to get into the alternative investment space, which is, hey, we want to give more people the option to achieve financial independence. So I'm all for that.
And one thing we like to, teach people too is, how to invest in syndication funds, because a lot of people will just go throw 50, 100 grand at something and they might not have the experience. They're like, oh, let me just go try it. Well, the Reg A world, most of these offerings have $5,000, $10,000 minimums. So you can either A, diversify, or C, oh, this is the questions I should ask, or, I see certain things from me. So all of a sudden it's like, oh, well, Chris, Larson just came out with a fund. People are more prepared a lot of times to ask better questions. It's like anything. After you go through something, you realize, oh, I have more knowledge now.
Yeah. And I found that, if you go through something, it's like coaching, right?
Yeah.
If you do something that's free, you process it. If you have to pay for it or you have your own money involved, things get real fast, because you got buy-in with that. Just like with having kids, I was having a conversation this morning with somebody about kids. It's like, oh yeah, it's like once you have kids, you start paying a lot more attention to certain things in life, like school systems and all those sorts of things. So, again, 10 years ago, Chris, I remember seeing these tapes, so, for the audience, a tape it's like a ticker or a list of
a spreadsheet.
Yeah, it is. It's a glorified spreadsheet, right? Thank you. And I love my spreadsheets. But so you get these tapes with, tons and tons of loans, and then things started to dry up, about, 5 or so years ago. Share a little bit about kind of what you've been seeing in the note world, and, what do you think? We're talking a little bit about some of the stuff you've seen here recently, but kind of like historically what you've seen over the last 10 or 20 years, and then where you see things today and where they may be going for investors and opportunities that may be in the forefront here. Are you a high-income business owner or professional earning $200,000, $300,000 or even more a year, but still feel like you're living paycheck to paycheck? Are you comfortable working until you're 65 or 70 to retire, or do you want to achieve financial independence and live life on your own terms? You could join myself and Matt Ford and learn how we both became financially independent in our early 30s. We will teach you how to make, keep, and grow your money, teaching you strategies to maximize your earnings, keep your income that you've earned through tax strategy and legal structures, and ultimately teach you how to grow it by determining your personal investing strategy, as well as teach you how to analyze investments so you can grow your passive income to the point to live life on your own terms. Our coaching clients reliably do this in 7 years or less. To learn more, check out our coaching program at nextlevelincome.com/coaching. That's nextlevelincome.com/coaching.
Yeah. So I'll first use a caveat. 2008 to 13 was its own separate animal because of everything that went on. People were talking about, oh, buy loans at 10 cents, 5 cents on the dollar back then. Well, they could, because there was a lot of fraud and there was so much default at that point in time.
Tons of chaff in the in the tape. Yeah.
So I always joke, people who were doing notes 15 years ago are no longer around because they're retired because they made so much money back during that time. But take that aside. For us, we've always seen a consistent flow, and right now we're between $25 and $30 million company. We're buying, $1 million to $2 million a month in assets. Now, when you think about the mortgage market, it's $15 trillion.
Wow.
So it's big. At any point in time, there's usually 3 to 5% default rate, but because
Okay.
of COVID, that has gone down to like 1.5%. So the numbers have gone down significantly. And just like real estate, lack of inventory causes what? Prices to increase.
Yeah.
So in 2018, I could buy a loan at 40, 45 cents on the dollar. Today, I'm probably paying 75 cents on the dollar.
Okay.
Now, what's interesting though is, I don't pay too much attention to mainstream media because I don't believe a lot of what they say, just like the jobs report. They just had 800,000 jobs magically. So
it's bizarre. No, yeah, that's a good rule. If you're listening, let's underscore that. Turn off your TV.
Yeah.
Read a lot. not just on X, but read, dig down to the bottom of stuff. So you don't, because the news is entertainment or propaganda in some cases.
Yeah. Or there are some experts out there who are nonpartisan that are good to listen to. But I look at what's in front of me, and during the summer, it's usually historically slow. And again, I have historical data for the last 8 years of how much we see and when there are the peaks and ebbs and flows during a year. Between the end of last week and this weekend, there was about close to $1 billion of non-performing loans come across my desk to bid on, which we see about 200. We usually see about 200 million of assets, but usually about 20% of those are non-performing. So we went from like 40 million to $1 billion in a week. It was like, wow. And on top of that, Ginnie Mae, literally right before you hit record, sent that they've got 250 million coming out. And then HUD has 750 million coming out. So all of a sudden there's, all these loans that are starting to hit. And for us, we're starting to, finally, I think, see people being more flexible or starting to feel sense of pricing starting, just like homes right now. You're starting to see softening and stuff. Yeah. We're seeing a little bit with the notes as well. And being on the front lines of things, when we start looking at this stuff, what's interesting is we look at when these loans were originated. And what we're starting to see is a lot of loans originated 2020, 21, 22 are also a lot where we're seeing defaults. And excuse me, it somewhat makes sense because, people got these low interest rates, but people have a spending problem in this country, and people, including our country. But credit cards and credit card rates have exhausted. I have a friend who does a lot of seconds, he invests in lines of credits.
Yeah, so you have a primary, just real quick. So you have performing, non-performing, you have primary, secondary, or like a home equity line of credit.
Yep.
Most people.
Right. Yep. So what were a lot of people who bought homes in 2015 and 2016 doing during COVID?
They're probably drawing on their equity.
They're drawing on their equity to go buy a property, whatever the case may be. But now what's happened is a lot of them were doing it to pay off a lot of their credit card debt too.
Interesting. And if they had a home equity line of credit, typically that's a floating rate loan. So it may have been 3%, and today maybe say 8%.
Correct. Yeah. And guess what those people did since with their credit card, because their insurance, their taxes, their food, their gas, their car payments, everything's gone up. Guess what they've done? Now max out those credit cards, but all of a sudden there's no more equity line to pull. So we're starting to see that hit the market. And again, I may sound gloom and doom. This isn't a 2008 thing.
No, we want, like you said, we don't want fluff. We want what you're seeing out there. And it's true. Like, this is the real estate market ebbs and flows. And we want investors to understand what's going on out there. And I think this is a great perspective to come to it, Chris. So thank you.
Yeah. And when things are at historical lows at like 1.5%, everything always goes back to a norm. So, everything goes back to its mean, unless there's some life-altering event or catastrophe or whatever the case may be. So for it to get back to 3%, 4%, it's most likely going to happen. Just people in today's world think everything happens overnight because the stock market can move very quickly overnight. But real estate is such a slow play that go back to 2008 when you look at when everything crashed. the best time during that time, I think, to buy a house was like 2011, I think, or
Yeah, it was a little
12.
while. Yeah.
Yeah, it wasn't
Yep.
9 or 10. It was actually
Yeah.
let things play out a little bit longer. And it's typically what happens that people forget.
Yeah. No, exactly. People do forget. I was just having a conversation at an appointment today with the nurse she's 27, super
Yeah.
smart, was in the military, Gen Z, very open-minded. We were talking about the differences between her generation, millennials, and how things go in cycles.
Mhm.
There's a great book out there. If you haven't read it, you're listening today. It's called "The Fourth Turning Is Here" by Neil Howe. And whether you believe in what he's talking about with what's going to occur, he talks about how generations go in 4 generational cycles over about the course of 80 to 90 years.
Mhm.
And what's interesting is he talks about how, kind of the third in line of those generations are typically the ones that start wars because they forget because they haven't seen war in so long.
Mhm.
And, if things go in cycles like the real estate cycle, if you're a millennial today, you may kind of remember, the housing crash, but you just think the market goes straight up, you know, because you weren't in the market, you weren't in the real estate market, or that was an anomaly. But I saw my parents lose their jobs during the savings and loan crisis in the early 90s. I saw what happened during 9/11. I saw what happened during,
Mhm.
07, 08. I saw what happened during COVID, and you see the cycles repeat. You go back to episode 100 of my podcast, and I talk about these cycles. So, Chris, I think, this is why it's so important not to erase history, but learn
Mhm.
from history. Because if we can study and learn from history, then we won't be doomed to repeat it.
Yeah, my first house I was actually supposed to close on, I think, 9/11 or a day before, and it got
Oh,
delayed
wow.
because,
Yeah.
and I remember at the time,
Mm.
my parents, the interest rate was, around 6% and it
Yeah.
was floating. And when
Yeah.
they bank came back and said 6%, they're like, lock that, you will never beat that,
Yeah. And then they
and
dropped. Yeah.
yep. And at that
Yeah.
point in time, I bought my house in 2001. My first house, I lived in there for 4 years and it appreciated about over 4 years, like 10%, like,
Yeah.
a few points per year, but
Yeah.
not anything crazy. I mean, it went with kind of what the economy did.
Mhm.
And you really had to live in a house 4 to 5 years to sell it and make anything because of your selling commissions,
Yep.
that you were paying. And then, 2005, 6, 7 was crazy where prices just started getting insane. And it was easy money at that point in time for
Yeah.
loans. But, I go back to, like you said, learn from it, that
Yeah.
houses don't, and I see people today thinking, oh, I'm going to think this house is going to appreciate the $150,000 house. And it's like, oh, it's going to appreciate 8% per year. And I'm like, over the last 50 years, it was 100, it was,
Yeah.
30,000. Like it's the lower value homes appreciate much slower than the higher value homes.
Yeah.
And like people think that, oh, well, it's going to keep going. I'm like, probably not.
No, over time, it basically equals out to inflation,
Yeah.
so you're kind of keeping up with inflation. But you know that's one of the reasons we love real estate, is that you can leverage it, right? And you can have
Yep.
somebody else pay it off if you're doing that. Or you can do a fix and flip. You can buy at a discount, you can negotiate and do those things. So Chris, you're starting to see some opportunities pop up. Share with the audience how they can get in touch with you, how they can learn more about what you're doing, if they want to learn about the business and ultimately learn about potentially investing with you guys.
Yeah, they can go to our website, which is 7einvestments.com, the number 7, the letter E, investments.com.
Yeah,
I'm sure you'll put that in the notes. Uh,
absolutely.
and, can reach out to us at invest at 7E Investments. So that's the best way to reach out to us, get in touch with us.
Yeah,
I love talking real estate. So whether it's notes, as we mentioned, I've been in construction, development, you know, I've built, my favorite thing to build, I think, is like an MRI suite, which was really cool, getting the
oh,
machine put in
wild.
there.
Yeah, yeah,
And the types of lead in the walls and stuff and so
yeah,
forth.
yeah,
But yeah, so I just love talking about what I've been through, my life, my journey. Uh, and I like to try and just keep it real with people.
yeah,
I'm not there to try and convince people that you're going to become famous or a millionaire overnight. It takes a long time,
yeah,
but you can also start in 22 or 52. Doesn't matter when well, it matters when you start, but there is no, I'm too old to get into
yeah.
real estate.
Yeah, I love that. Great philosophy. I think us engineers and nerds need to stick together. And we'll continue this conversation for sure, you and I. But if you want to talk to Chris and continue this conversation with him, check out 7E. That's the number 7, the letter E, investments.com. You were right. We will have that in the show notes, Chris. We wish you all the best in business, all the best health to your family going forward here. And thank you so much for sharing your story and what you got going on with the audience. If you're listening today, please like and subscribe and share this with somebody that you think may find value in our podcast today. Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.